Hello. Oh, I'm so happy to be with you. So, we're getting into that leaves off the trees zone of the end of the year. And one of the great missed opportunities that a lot of people, especially busy people who work for themselves like you, that a lot of people like us miss is the ability to take advantage of some last minute savings that you can do at the end of the year. So there is a name for this, and I don't want you to run away screaming when I say it. It's called year end tax planning. Now, I know a lot of people like us really just tune out when it comes to the idea of year-end tax planning. Maybe it's because you're a maker or involved with holiday sales. And so this is just your busiest time of year. And it's just a thing. It's a bridge too far. It's a thing you can't feel like you can't think about. Sometimes it's just you're a busy parent and the holiday season is just bananas because you have people visiting and you have a lot of errands and cooking and parties to attend and presents to buy and ship and all that stuff. So maybe it's that. I also suspect that year-end tax planning feels like an optional thing for taxes. And a lot of us are like, oh my gosh, why would I do any tax thing that's optional? And I'm just here to say, I really want you to consider it because year-end tax planning, the whole reason you do it is to save a lot of money, to actually have a bunch more money. And it's something that everyone can do. You don't have to be wealthy. You don't have to have an accountant. You can absolutely do it. So I want to give you the free version in the next couple episodes as we approach the end of the year so that you can take at least one tip from my next 3 episodes, at least one tip, and save some money. All right, deal? Okay, so that's your goal. I'm going to be with you for the next several episodes teaching you ways that you can save some money at the end of the year. And I'm going to try to keep these as bite-sized and manageable as I possibly can. So instead of doing one mega episode on year-end tax planning, I'm going to break it up by topic so that you can just kind of take one thing at a time. I think that's a little easier. All right, so today I want to talk about one aspect of year-end tax planning to save you money, and that is healthcare. Okay? So I'm just going to talk about all the healthcare related things you can do at the end of the year to save yourself a chunk of change. Here we go. First of all, the end of the year is open enrollment period for marketplace health insurance. So if you get, Affordable Care Act coverage, if you have are interested in healthcare on the marketplace, or switching to enrolling for the first time in healthcare on the marketplace, or switching plans, now's the time. Open enrollment period for healthcare.gov is November 1st to January 15th. Now, please pay attention and note that that is only for healthcare.gov. Private insurers tend to have shorter windows. They overlap. They're usually mid-November to mid-December, like just 1 month instead of 2.5 months, like the government. Okay, so keep that in mind. But if it's marketplace coverage, November 1st to January 15th is your open enrollment period. This is your chance to log on to healthcare.gov, look around at the plans, see if there's been a pricing change, see if you need increased coverage or less coverage, and now is the time if you want to make a switch. For the rest of the year, you are only allowed to change your marketplace coverage, whether it's getting it for the first time or switching plans, if you have a life event, a qualifying life event. So that can be something like a marriage, having a baby, losing your healthcare coverage from another source, or a change in your household income. Okay, so this is open enrollment period. Take advantage. If you want to switch plans, now's the time to hop on healthcare.gov and look at the plans and see if you want to make a change. If you have private insurance, there's a shorter window for open enrollment. It's generally mid-November to mid-December, but you'll have to check with your individual plan. So this is also the time of year to check if you have private insurance to see if you want to make a change in your plan. Medicaid and CHIP, Children's Health Insurance Program, those two programs, just FYI, those are a little bit different, and you can actually enroll or change any time of year. Okay, so that's just a little note for you. All right. And next, I just want to talk about the two types of savings plans that people often confuse for each other. So I want to tease out the differences. But the two types of health savings plans, um, and what their limits are and kind of what the benefits are. And I'm really going to put the focus on the one that you are eligible for as a person who works for themselves. Okay, so the two kinds of plans that people get confused a lot are FSAs and HSAs. Okay, FSAs stands for flexible spending account. These are set up in general as part of a benefits package, if you are employed, right? If you have an employer. So for most of you listening, that's not you. Most of you are listening to this podcast because you're self-employed. But I want to remind you that you may be married to somebody who has a workplace benefits package. And so it is important for you to still know about this because you can still take advantage through your spouse's workplace benefits. Okay. So a flexible spending account does not roll over. It's much less flexible. Ironically, there's a less flexibility in the one called flexible. Um, it does not roll over. So you need to you're only putting the amount of money in an FSA that you plan to spend for the year. I know that's a little annoying because who knows when you're going to have a health emergency and you kind of want the money there. You want more money if you have an emergency, says the woman who needs some dental surgery this year. Um, so you want to be a little more careful about the amount that you put into a flexible spending account because it does not roll over. Some plans will allow a 500 that you can get $500 of the amount that didn't roll over, but otherwise you just lose the money in your FSA if you don't spend it at the end of the year. This is the reason you're going to see all those eyeglasses, Warby Parker ads at the end of the year about getting contacts or glasses, because that's a good way to spend up the last of your FSA money if you have it and you haven't had a healthcare need to spend it on. But, it's not too late right now to schedule that last dental cleaning, or if you want to do that and you have an FSA, the end of the year is the time to do it because that money won't roll over for you. All right. The limits of money you can put into a flexible spending account are $3,200 per spouse for the tax year 2024. Okay. So this is your last chance to put money in. And the whole tax benefit of putting money into an FSA is that it reduces your taxable income by that amount. So if you make $100,000 per year in income and you put in $3,000 to an FSA, your taxable income, instead of being $100,000, will be $97,000. Okay. That's how it works. So it gives you a little bit of tax savings. And year-end tax planning in general is all about noting every single available tax shelter, like an FSA that you have available, and putting the maximum dollar amount into every single one so you get even bigger tax benefit. Okay. It's a little bit like tweaking all the dials rather than there being one silver bullet. Okay. So FSAs are probably the one that apply to you the least, but definitely check if your spouse has a workplace benefits package. If they have access to an FSA, they're very worthwhile for those basic expenses you're going to have every year. 2 dental cleanings, maybe a new set of contacts, etc. Now, a different kind of plan is called a health savings account, HSA. HSAs are magic and wonderful. And HSAs you are allowed to have access to on your own. You don't have to be covered or offered it through a workplace plan. You are eligible to open your own health savings account, HSA, so long as you have a qualifying high deductible healthcare plan. So I think of HSAs as a bit of a shit sandwich, right? The reason you get this incredible savings vehicle to put money in to pay for qualified medical expenses is because you have terrible healthcare. So in other words, this gets paired together in your mind with a high deductible healthcare plan. When you have one of those, you were allowed to open this really awesome savings account that gives you a big tax advantage so that you can use tax-free dollars to pay for those, high deductible expenses, because you're going to have more out-of-pocket expenses when you have a high deductible healthcare plan. Okay. So HSAs are a shit sandwich. They come along with terrible healthcare. All right. But with that said, HSAs are kind of magical and cool. HSAs, very unlike FSAs, HSAs do roll over year to year. So you can keep putting money into your FSA so long as you're still eligible because you have that high deductible healthcare plan. You can keep putting money into it, and you are allowed, and it rolls over and rolls over. So you can have a big pile built up for the year that comes where you do have a medical emergency that costs a lot of money. And if there's a year where you don't have any medical expenses, you can simply have that money sitting in the account and not have to touch it. You don't have to spend it all down by December 31st. This is one of the magical qualities of an HSA. Another magical quality of an HSA is that it operates in a similar way to a retirement account, and it's actually got a bigger tax benefit. So when you put your money into an HSA, you are allowed to invest it. So if you know you're going to need it soon, you might want to simply put it into like a high yield savings account. So you get, it's money sitting around. You want it to generate interest at least if you can. But if it might be longer term, if you're young and relatively healthy, you are allowed to take the money in your HSA and invest it. So you can absolutely put it into a well-diversified basket of stocks and bonds and have that money actually be growing with compound interest. This means if you have an HSA for 10 years, you can have that money growing in the stock market, in stocks, equities, and bonds, right? This is pretty awesome. And when you take that money out to pay for qualifying health expenses, it is tax-free. So HSAs are the only tax shelter I am aware of where you can put money in tax-free and take it out tax-free if you're spending it on health-related items. So HSAs are kind of magical. I particularly love them. But again, there's a shit sandwich quality to them where you have to have high deductible health coverage in order to qualify. And yes, you can go onto your provider's website and check if your plan is a qualified HDHP, high deductible health plan. All right. So the HSA limits for 2024 are you can put $4,150 into one if you are single. You can double that to $8,300 for a family. And if you are over age 55, you get an extra $1,000 that you can put in as a catch-up contribution. Of course, as we know, as we age, we tend to have higher health expenses. So that's really useful, that catch-up contribution. So I definitely do think that it's good. It's a good idea to consider maxing out an HSA every single year because you can have that money invested, because it goes in tax-free and it comes out tax-free. So it's a really amazing savings vehicle. So one takeaway for you today, if you know that you have high deductible healthcare coverage, I recommend opening up an HSA. You can go to a brokerage like Fidelity or Charles Schwab. And there are some companies on the internet that also have HSAs. But, since a brokerage can do it, it should not be a thing that costs you money. So just buyer beware. So I recommend that you open one and put in the maximum amount of money, have it invested, maybe in a high yield savings account. If you don't think you're going to need to access it for a while, you could invest it a little more aggressively. And it's a great way to save money. So I did a little bit of math for you just to sort of show you the savings. I just plugged in a number for, if we take an example of a self-employed person who files single, making $75,000 per year in self-employment income. The tax on $75,000 of income, and I just plugged this into an online tax calculator, if you're curious how I came up with this, the tax would be approximately $17,778 on $75,000 of income, okay? So here's what happens when you put in the maximum for an HSA. Here's what the savings would be on that. That $4,150 contribution will reduce your income by that amount. And then the resulting tax would be $16,865. So just to do the math there for you, what that ends up saving you is $913. So you save almost $1,000 for this $4,150 contribution to an HSA, plus that money can grow because you can put it into a high yield savings account or investments. Plus, when you take the money out to pay for medical expenses, dental work, contacts, glasses, eye exams, medical needs, Band-Aids, there's a huge list of eligible items. You get to spend the money tax-free. So it's a really wonderful savings vehicle. I highly, highly, highly recommend it. All right, so that is my healthcare related tax savings items for the end of the year. I hope you take advantage of at least one of these today. Open enrollment period, checking if you or your spouse has an FSA offered in in a workplace benefits package, or checking to see if you've got a high deductible healthcare plan and can open an HSA and max it out for some great tax savings. All right. And my last thing I want to mention, coming up this year at the end of 2024, December 31st, is the deadline to do your mandatory LLC filing called a beneficial ownership information report. I've done several episodes on this new mandatory reporting for all LLCs and a couple of other entities. So if you have an LLC and you have not yet filed your BOI report, your mandatory new report for LLCs, I have a little free mini course. It's just about 15 minutes, and it shows you how to do the filing for absolutely free in about 10 minutes. So I highly recommend, because the deadline is coming up December 31st. There's up to 2 years in prison if you don't file this report, and fines begin at $500 per day up to a maximum of $10,000. This is not something you want to miss. There are scams out there trying to charge you a bunch of money to do this filing, and it's not necessary to do it. It's not necessary to pay. I've made this free course. I highly recommend it. And so I will just encourage you to share this URL with any friend who has an LLC who hasn't filed this report yet. It is mandatory. Sunlighttax.com/LLC. You can just click that link, and I have a free, very small, very short 15-minute course on how to do that filing. Your deadline is, again, for year-end purposes, your deadline is December 31st if you've had an existing LLC. All right, so I hope that helps all of you. That URL one more time, sunlighttax.com/LLC. I hope this has been a good healthcare savings episode for you, and I will be back with you next week with another tax savings episode for the year end. All right, great to be with you. I'll see you next week. Thank you for watching. If you like this video, be sure to like, leave a comment, and subscribe to my channel. I'm so grateful for that. This video is for education and entertainment only. Nothing in this episode should be taken as individual tax or financial advice. You can find all the tools, books, and links I reference at sunlighttax.com/podcast.